All right, welcome to Talk Tickers. So, TripAdvisor just dropped its Q2 earnings, and, well, it's a bit of a head scratcher. Revenue was basically flat, nothing to write home about, but the stock just rocketed up over 11%. Now, that doesn't really add up on the surface, does it? So, what exactly did Wall Street see that maybe the rest of us missed? Let's dig in and find out. And yeah, that really is the central puzzle here. You've got revenue that's just fine. Met expectations, but that's it. But then profits absolutely crushed it. So what gives? Why the huge jump in the stock price? Well, as you'll see, the answer isn't in those big, flashy headline numbers. It's buried a little deeper in the story behind them. Okay, first things first, let's pull up the Q2 scorecard and see exactly how the numbers stacked up against what Wall Street was expecting. And here you can see that contrast clear as day. Revenue came in at $529 million. Like I said, it was fine, nothing special. But, and this is a big but, look a little further down the list. Both earnings per share and adjusted EBITDA, that key metric for profitability, they both came in way ahead of what anyone was expecting. That was the market's first big clue, right? TripAdvisor is getting a whole lot better, a lot more efficient at turning every dollar of sales into actual hard profit. And this, right here, is where the real story starts to unfold. You see, the smart money on the street, they looked right past that flat revenue number. They were focused on something else entirely, a massive shift happening under the hood, deep within the company's three main business segments. Hey, and don't just take my word for it. The CEO, Matt Goldberg, he basically laid it out for everyone on the earnings call. He made it super clear that the business isn't really driven by that old classic TripAdvisor brand anymore. No, the new engines are its high-growth marketplaces, Viator for experiences and TheFork for dining. And this chart, it shows you exactly what he's talking about. Just look at these numbers. Viator and TheFork, when you put them together, now make up more than half of the company's total revenue. They've officially overtaken the old-school TripAdvisor brand. This isn't some plan for the future, you guys. The pivot, it's already happened. The whole center of gravity for this company has shifted. But a pie chart is just a snapshot in time. The real signal, the thing that got investors really excited, is the massive difference in the growth rates. Just how fast are each of these pieces growing? That's the key. Let's start with TheFork, their dining platform. It is absolutely on fire. We're talking a massive 28% revenue growth year over year. Wow. Then you've got Viator, the experiences marketplace. It's posting really strong, solid 11% growth. This thing is now the core engine of the entire company, no question. And then there's the old brand. It's actually shrinking, down 3%. So when you put these three numbers side by side, the story becomes crystal clear, doesn't it? The market isn't placing its bets on the past, it's rewarding the future. And here's the real kicker. This isn't just growth for the sake of growth. These new segments are becoming incredibly profitable. Get this, just 2 years ago, Viator and TheFork combined lost $61 million. Now fast forward to the last 12 months, they've generated over $75 million in adjusted EBITDA. I mean, that is a monumental swing from burning cash to generating it. A total game changer. So let's recap. You've got a successful pivot. You've got high-growth segments that are now highly profitable. The big question is, how did the market translate all of that into a dollar value? Let's take a look at the final verdict. This timeline really tells the whole story, doesn't it? The stock closed at just over $16 right before the earnings call started. Then, by the time the market closed the next day, after everyone had time to digest the news, it was trading at almost $18 a share. Do the math on that, and it comes out to a one-day gain of 11.7%. I mean, that's a loud, clear, and decisive verdict from the market. It absolutely loved the direction this company is heading. So if we were to sum up the bull case that basically emerged overnight, it looks like this. You've got expanding profit margins. You have a growth strategy in Viator and TheFork that's clearly working. Cash flow is looking way better. And then you have these two huge wildcards in the mix. A brand new activist investor on board, plus a management team that's focused on future tech like AI. You put all that together, that is one powerful combination. Okay, so that pretty much explains the market's reaction to this quarter's results. But as you know, investing is always about the future. So let's shift gears and look at the company's guidance, and I'll lay out our thesis for the road ahead. All right, so management's official guidance. They're calling for some pretty modest revenue growth overall. We're looking at 4 to 6% for Q3 and 5 to 7% for the full year. Now, this definitely shows that the legacy brand is still a bit of a drag, but honestly, it's a stable outlook. And that stability gives those high-growth segments plenty of room to really shine. But here's the thing. The company's own guidance might not even be the most important factor right now. The real story, the one to watch, is the arrival of activist investor Starboard Value. They now own over 9% of the company. And let me tell you, when an activist like Starboard takes a stake that big, they are not there to just sit on the sidelines. They're there to shake things up, to force change, and to unlock value for shareholders. So when you take all of this into account, the strategic pivot that's working, the seriously improving profitability, and now this activist catalyst, well, our rating on TripAdvisor is a firm outperform. And here's our thesis, broken down. First, we believe the market still isn't giving Viator and TheFork the credit they deserve as high-growth, standalone businesses. A sum-of-the-parts valuation points to some significant upside. Second, we fully expect Starboard to start pushing for moves to unlock that value, maybe something like a spin-off. Third, this whole margin expansion story, we think it has plenty of room to run. And fourth, that legacy brand, even though it's not growing, is a stable cash cow that can keep funding all the investment into the exciting parts of the portfolio. So we'll leave you with this one final thought, this one big question. After seeing these results, is the market finally starting to see TripAdvisor for what it's actually becoming? Not just some tired old legacy media site, but a modern portfolio packed with valuable, high-growth travel marketplaces. If you ask me, this quarter's reaction from the stock market, well, it suggests the answer is a resounding yes. And of course, remember, this is not financial advice.